Let me show you one of the most expensive real estate tax mistakes I see as a CPA. It happens when a rental property is sold without planning for a 1031 exchange. One decision can easily cost you six figures. Okay? Here's a rental property. This is an example rental property bought for $500,000, $100,000 in improvements to the property. Okay? Now, after depreciation, for the tax purposes, the adjusted basis, okay, for the sale is at 450. See is both examples. No 1031 and a 1031. I want you to see the difference. Now, the sale price for the property is $1,000,000, okay? Without a 1031 exchange. Okay, this is without a 1031 exchange, meaning I didn't use it to invest in the next property. I just took all the cash out, okay? You get a taxable gain of 550,000. You have to pay taxes on that, okay? When you add capital gains tax in, the depreciation recapture, these are the IRS rules, and then the state taxes, okay, nearly 180,000 gets lost to taxes immediately. 180,000 in this example. Scale that up if you have multiple properties, okay? Look at the cash available to reinvest. That's what I want you to see the difference, okay? If you did do a 1031 exchange, okay, and filed the forms correctly, you would have that $1,000,000 in your hand. But you can see the difference. This is why planning is so important when you're going to sell a rental property or any property in general. Make sure you're speaking with your CPA before you do anything, because there is a small window where you get to do this. You can't retroactively come back and do these things. There is a time limit. Okay. Now, a 1031 exchange isn't about avoiding taxes forever. You're going to have to pay eventually, but it's always better to defer taxes. It's always better to defer payments as long as you can, as legally as you can. Your goal is to keep capital at work so that you can buy more. Okay. And again, I've seen many people with much larger sums of money lose millions of dollars in taxes because they didn't properly plan. That's less that they can invest with. It's a serious amount of money. Now, this is a simplified example, but the impact is very real. This is why tax planning, proper tax planning, has to happen before the transaction, not after.